Thank you so much for being with us. So give us your big picture thoughts here as we're coming up off the lows and we're breaking out to some new levels.
Yeah, so basically, the bull case is just that unemployment claims peak before the market, the market bottoms out before unemployment claims peak. Also, if the markets retrace 60%, then the likelihood is that the bottom is in, according to the post-World War II bear market cases. So that's sort of the bull case in. However, what I'm looking at is 2968. If the S&P cannot take out 2968, we might have a reversion to the mean at 2500. That's a big sell-off. 2,500 is also a higher low, which supports the long-term bull case. If it doesn't hold, we've got a gap to fill from April 3rd at 2,538. So those are the numbers I'm watching for the time being. But we see some significant resistance up here. Our price-earnings ratios are kind of returning to what they were pre-COVID, and that seems to be a bit of a disconnect from Main Street.
Yeah, we're at 29.34, and I see what you mean. Like you're saying that when we get up to these levels and we'll start butting up against that kind of resistance, we need to at least hold this level, or at least we're holding 2,900. But if we're not able to break out of this 29.68 resistance, then you're saying we could then go back down to the 2,500, which is the higher low. Is that correct?
Yes, exactly. So that would be sort of the reversion to the mean and where is fair value. And that kind of makes sense given the economic data being as bad as ever. I think that there's a general consensus happening that, we've seen the worst of it and that the economy is going to turn on like a light switch. But as your previous interview pointed out, airlines are still going to struggle for quite a while. And there was such a backlash to any United flight selling those seats.
Yeah, no doubt, no doubt. I know you have Apple and Microsoft on your radar, and those are some names that you like. Tell me a little bit about Apple and Microsoft each individually. Why do you like them?
Well, no, the thing is in the short term, they're overbought. But the thing that kind of, when we look at the overall marketplace and we realize that the tech sector is so far up, they represent about 42% of the tech sector. So is that a sustainable move going forward to warrant these market levels? I mean, as stocks individually, they're a little overbought for my taste at this price point.
So when you look at those two and you talk about the representation in the tech sector and them being a little overbought, I mean, does that translate to overvalued? So are you saying that you wouldn't get in there now? You would wait for a pullback and then you would entertain buying or recommending buying Apple and Microsoft?
Yes, again, the market would have to pull back at least 10% for me to get back into those names overall. And we'd have to have a higher low, and we'd have to have more buyers come in, and then we'd have to have the COVID cases declining substantially. We'd have to have better than expected, reopenings, less businesses going out of business. We'd have to have the unemployment back off before I want to substantiate valuations that basically were pre-COVID.
Right. And then we talk about oil, which, we have Saudi Arabia talking about pausing on some production, right, 1 million barrels, and that starts in June. What are your thoughts there? I mean, one of the ideas here and that I was talking about with people was that what's going on with the dollar, inflation, deflation, the printing, and commodities. So we're printing a lot, right, which would think inflation, but commodity prices are falling so quickly, faster than we're printing, which then means deflation. I mean, where do you stand on all this? What do you expect to happen in the next month or two?
Right. So when the money supply grows precipitously, we always expect eventual inflation. The thing is that what's happening is the money supply is growing, but it's going into debt service very rapidly. So it's not really having the trickle down effect into the economy. And then obviously we have such a demand crunch from having the shutdown. So those two factors currently combined, I think that the risk is deflationary, not inflationary, even though we had a bit of an uptick last week in some of the commodities. I still expect the 10-year yields to kind of go lower because I expect more weakness in the economy. I still expect the dollar to be strong for the time being. I still expect gold to be a flight to safety for the time being. And bonds pulling off today, but I still expect that to be, a safe haven for the time being, certainly.
Yeah, you talk about bond yields, and I know today was a little bit different because we were about 0.7, right, 70 basis points on the 10-year, but earlier in the day we'd been at like 0.67. So where do you expect bond yields to go? I mean, I know, are you saying like back to 50 basis points, or where do you think the 10-year heads?
Well, it's maybe back to 50 basis points. The things that I'm watching right now is that Jay Powell came out and said that they're not going to adjust the target range for the Fed funds rate, off of 0 to a quarter point until we have full employment and price stability. But what's interesting is that if you look at the forward curve on the Fed funds futures, they're pricing in negative rates as you move forward. So I do expect interest rates to be remarkably weak for some time.
Yeah. Francis, just a final thought, and that is obviously our Fed head, Jay Powell, whom you referred to, and the team are saying no negative rates. I mean, that's not for us. That's not for our country. But that they may, in fact, at some point have to succumb to the pressure, because when you have, and this has happened in other countries where they have the futures, like what we're seeing, like you just said, about them being negative, that at some point we may, in fact, see negative rates.
Absolutely. Negative rates are a tool for debt service. So, as our debt grows precipitously and as these stimulus packages, the fiscal stimulus alone represents about 12.1% of our GDP, our debt to GDP is going to grow quite tremendously. And, we're not going to have enough GDP maybe to have enough tax income to make servicing the principal on that debt, even if it's interest-free loans. It's going to be very, very difficult going forward. So, it's all about debt service, and, negative rates, as awful as they are, they're preferable to massive default.